Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at Options Play, and welcome to the Essential Options Concepts, Understanding Calls and Puts. So if you are new to options, you picked an interesting time to learn about options, which is becoming more and more popular amongst people that own stocks, and mainly because of the concept of how options can be used to try to define your risks as far as your stock trading portfolio is involved. This entire presentation will last about 1 hour. We're going to go through a PowerPoint, and if you have any questions, please feel free to put them in the Q&A box. You will see a box that has a question mark on it, and if you use that, that allows me to organize the questions, and I will try to address them along the way. So right now, I think you are seeing my PowerPoint that I'm going to be using today, and I think it's time to begin. Here we go. First of all, when you're thinking about options, and we're going to be showing some real option chains today, they're going to be a little bit delayed. They're going to be, from back in time, but nothing that we show or use today is meant to be a recommendation or advice, and past performance is not a guarantee of future results. Now, if you are going to be trading options, you do want to review the characteristics and risks of standardized options. You can receive that through First Trade if you'd like, or if you'd like, just ask them for a copy of it and they will send you one. All right. So we're going to review the basic terms of puts and calls. We're going to talk a little bit about pricing today, about what makes up the price of an option contract, but more importantly, we're going to really go through the option chains, and we're going to dissect what an option contract is. Then I'm actually going to take the time to run over, and we'll look at some things, and I'm willing to address any questions that you may have during the event about what's going on in the marketplace and how we can use options to try to offset some of the risks in the market. Now, if obviously, as far as options are concerned, if you're doing the joining right now, we're a little bit late to the game to try to protect. One of the trades that I'm going to look at today is a little bit of a double up to catch up type trade if you're behind on a position. But we're going to look at just buying a call option outright, just buying a put outright. Talk about things like open interest. Talk about the volume on the options marketplace, and that's going to be the agenda for today. And there will be a Q&A throughout the event, but when we get to the end of the event, we'll open it up mainly for questions at that point in time. So first of all, what is an option? Now, when I begin with a very basic option course, I usually try to address the fact that a lot of people come to the event with, I think, the wrong mindset. In other words, they think of options as a speculation tool. I'm going to learn how to get rich using the leverage factor that's in an option contract, as opposed to where options actually came from. They came from a need to protect an asset. So they go all the way back to the Dutch aristocracy and the tulip bulbs in the 16th century. There was a frenzy of tulip bulb buyings, and people popped up that were insuring these option contracts and saying, or these tulip bulbs, and saying that if the market ever collapses, we'll guarantee a price for these tulip bulbs. So option contract trading has been around forever. And it's just a contract. So prior to listed exchanges, you would actually write up a contract, and you would hand that contract to someone else, and someone would sign it. So if you actually look at the marketplace before option trading happened, you will see that in newspapers, they used to actually show contracts, a written out picture of a contract of an option saying that if you want to buy this option contract, give us a call because we will transact it with you. So here's what an option is. It's a contract between a buyer and a seller, and the buyer pays a premium and can execute the right inside that option contract. The sellers then take that premium and they take on an obligation. That obligation is going to be to fulfill the terms of the option contract. Now, it's issued as a put or a call, and a call contains the right to buy, where a put contains the right to sell. One second, let me adjust my slides. I think I might have to go through this because for some reason, yeah, let's do it this way. For some reason, it's not showing as the entire slide. Okay, so we'll roll with this. So if I look at this slide, yeah, I guess we're okay. And I think about what a call or a put is. So what a call will do for you, and this is once again where the term comes from. So think about an option contract from the sell side of things, not from the buy side of things, right? So if you start with the concept that options were initially made to try to protect an asset, if you sell a call option, that allows somebody to call stock away from you. And that's where the term call comes from. If you sell a put option, that allows somebody to put stock to you. And that's where put comes from. So not only are they contracts that are very similar to an insurance contract or something that would be written where the person that is selling that contract is referred to as the writer of the contract, just like in the insurance world. Once again, what do you call somebody that sells you your car insurance? You call them the underwriter of the contract. But if you come from this side of the coin, it's easier to understand a lot of the terms that are involved in the option trading world. And you'll notice here on my slide, you see the premium or the price of the option contract. Once again, when you pay for your car insurance, what do you say you are paying? You don't say you're paying this price, you're saying you're paying the premium for your car insurance. And that's another term that comes directly from the fact that an option contract was developed to try to protect something. All right. So here's the anatomy of an option. And then we're going to go through a quote, and you're going to see that that's just really a truncated option contract. The anatomy of an option contract says that what are we agreeing on? And in this instance, what product are we agreeing on? We're going to talk about stock options mainly today, but options can be traded on a whole bunch of different underlyings. You can trade them on exchange traded funds. You can trade them on index options. You can trade them on futures contracts. You can trade options on things that you just want to make up if you would like to, but mainly because they're a contract, and that's all that they really are. What price are we agreeing on? We know that the stock's got to either be called away or put to somebody. So at what price? And then what time frame? So time is money, just like it is in the insurance world. The longer your insurance contract would be, the more you have to pay for it. There's a plethora of different expirations in the option trading world, and we need to come up with that time frame. But after that time frame, that option contract ceases to exist. And that's what's much different than in the stock trading world, right? So we need to contract them out. What are we agreeing on? Most contracts will represent 100 shares of stock, and that's 99% of the time. Now, if there is a merger or acquisition, I do want to highlight that, some of the landmines of option trading too is that sometimes the terms and conditions can get a little messy. Stocks do stock splits. One company buys another company, and when that stuff happens, this can change. But if that doesn't happen, options are initiated as 100 shares per contract, and that's very important because that is your multiplier when it comes to the price of the option contract. And then we need the underlying security. Now, I don't like that term, underlying security. I like to just say stock options because it's very straightforward. But as I mentioned, there are many different that can be traded. Security just stands for all of these. Stocks, ETF, indexes, currencies, they're all referenced as securities in the marketplace. What price are we agreeing on? This is called the strike price. This is obviously a very important thing. Where is the strike price relative to where the stock is at? That matters a lot in the pricing of the option contract. So this is the price per share that you're going to pay. We know that that contract represents 100 shares, so the strike price would mean this is the price that I'm buying the stock, 100 shares at, or this is the price that I'm selling the stock, depending on the type of the option contract. And then we have the expiration date. Normally on Fridays, they're changing that. This is changing all the time. If you're trading in index options, which we're not going to talk about much today, they have option contracts that will expire every day of the week. But normally your expiration date is going to be on a Friday, and that's just the most common. The original option contracts only traded with an expiration date on the third Friday of the month. And that was always the expiration date. But that has changed a lot just within even the last 5 years of the option trading marketplace as options get more and more popular. All right, so I'm going to throw in the terms of our fictitious option contract, right? So we're talking about we're going to look at 100 shares of one option contract, which will represent 100 shares of stock. We're going to make up a company called XYZ. The prices that we're agreeing upon, the strike price is going to be 100, and we're going to go out 36 days to expiration. It says March 15th, but obviously that's not this is just a fictitious example, 36 days away. So what are we agreeing on? Are we going to buy a call or are we going to buy a put? Call option is the right to buy, or the put option is the right to sell. What product are we agreeing on? That product is going to be ABC here. Now, in this instance, we can exercise, or the option contract can expire, or it can be traded. So there's different vernacular that's used in the options trading world. And we're going to talk about how often these things happen. And then we decide on the price or the premium. So we're going to buy one option contract. We'll stick in the call option world. It's a lot easier to understand. And then also we are going to decide what the agreed upon price would be. And this was the start of quote pages in the options trading world. Like I said, contracts used to actually get advertised in the paper or some type of publication. And then they would say, this is the price. And literally there would be a conversation about that price of that option contract. And that's how it would be traded. And then most of the time back in the day, options were exercised. And we'll talk a little bit more about that here in just a bit. So here are the 4 basic positions for options. And I'm going to look at a quote option, and we're going to pull up some option chains within the First Trade platform. I'm going to use it inside the PowerPoint slides because I'm going to highlight a few things. But if we look at the 4 basic positions of an option contract, no matter what option strategy you have, you can talk about these fancy bull call spreads, bear put spreads, butterfly trades, all those weird little names that they have for these option strategies, but they start from these 4 basic option trades. So if we're the buyer of a call option, you have the right to buy 100 shares of that underlying. You pay a premium for that. Once you buy that, you are considered long that position in your account. So if I buy a call option, I have the right to buy 100 shares of the underlying stock. Now, if I'm buying and with the right to buy, well, then that means I want the underlying stock to go up. If I'm the buyer of a put option, I have the right to sell 100 shares of the underlying. If I'm buying with the right to sell, that means I want the underlying market to go down because I want to be able to buy the stock at a lower price and exercise and sell the underlying at a higher price. Now, I've been teaching options for a long time, and I'll tell you this, that even astute option traders have a tough time phrasing their question right when they talk about puts, mainly because buy means sell. If I'm buying, I'm intending to sell the stock at the strike price. And that's a very hard concept to grasp. Where with the call option, I'm buying with the intending of buying the stock. So that's much more straightforward. And once again, the term call and put come from the sell side of things. If I sell a call, I then get paid the premium. And if you think of this, I'm acting as the writer of the contract. I am the insurance agent, if you will. I'm going to take on an obligation, just like if somebody sells you car insurance, they're going to say, you have the obligation to sell that car if you run it into a tree, or the obligation to buy a new car for you if that car gets put to you. So with that said, the seller gets cash, and for that cash they take on an obligation. Once you sell a call option in your account, you're looking to be short that call option. Also, a lot of times the seller is referred to as the writer of the option contract. Okay, sell a call, you got the opposite outlook of the buyers. So the buyer wants the market to go up, seller wants the market to go down. You buy a put, you want the market to go down, the seller wants the market to go up. So if I'm the seller of a put option, I'm bullish on the marketplace. And we'll talk about, it's very simple and straightforward and easy to be able to do put options and call options and sell them in this options marketplace. But there are some nuances that you need to do, and you need to understand the terms and conditions of that option contract and what you have to make sure that you're going to be obligated to do at a later date. Okay, so I just grabbed this. This is out of my playbook, the Options Playbook, and the optionsplaybook.com website, because really what happens when you look at an option contract, it is a truncated quote, or a truncated version of the option contract. So we talked about all the rights and obligations and the terms and conditions. Let's say here in this instance, we have XYZ stock, not ABC stock. But if you just look at this quote, XYZ December 17th, 70 strike call, and it's trading for $3.10, that takes everything we just talked about and sums it up in one little excerpt, if you will. So what's the underlying stock? Well, it could be Apple, AAPL, it could be IBM, it could be Amazon, AMZN. Bottom line is, if you look at an option contract, 99% of the time that option contract is going to represent 100 shares of stock. Then you have an expiration date. We're going to highlight that here. This one would be December 17th, 2025. It's usually a Friday. The common marketplace used to be the third Friday of the month, but nowadays they have weekly options. So you got every Friday there's an expiration date on almost all the stocks that trade option contracts. Very few and far between do not have weeklies now, at least the most popular underlying stocks. And then you have the strike price, and it's also called the exercise price because if we're talking about a call option, if you exercise, you're buying stock at that price. It's referred to as the strike price. And then lastly, if you get a quote on an option contract, and we're going to look at a lot of quotes, you need to multiply that by 100, and any commissions that you might pay or anything to get in, which you obviously don't do a lot of that at first trade, but any fees or anything that is involved, you pay that price times 100 plus any fees, and that would be the premium for the option contract. And once again, we call that in the options world, the vernacular for price is premium, and that comes directly from the insurance world. All right, so let's jump into an actual option chain. In this instance, we're going to look at Apple. Now, this is a little bit older. Apple is, I don't know where Apple's at right now, but it's obviously a very crazy marketplace at this point in time. But everything that we mentioned is inside this chain, and the chain makes it very easy for you to look at your option contracts and decide what are the pluses and minuses of buying this particular option contract, all right? So to start with, if you ever type in an underlying symbol, once again, underlying is the term that we use. In my slides, I said underlying security. Now we're just putting in the simple symbol, and we type in Apple and you hit go. All right. Then you have the chain type. You have puts and calls. You have a range of strike prices that are available to you. And then all the expirations. We have expirations, and we also have leap options and highlighted in here. Don't let that term scare you. It just stands for longer dated options, to be blunt. But it's a marketing acronym. It stands long-term equity anticipation securities, which is something the Chicago Board Option Exchange came up with when they introduced longer dated options. It's literally dated. They should probably just get rid of the term, to be blunt, because there are so many different strikes now. But leaps usually represent option contracts that go out over 9 months in time, because the standard options used to only go out 9 months. All right, now the expirations are very important. Like, you see all the different expirations. This February 9th, February 16th, 23rd, these are Fridays. March 1st, March 8th, March 15th. The ones that are highlighted are going to be the expirations that are going to be shown. In this instance, we're looking at the nearest term expiration from when the screen graph was taken, which is February 9th. That means that this option contract had 1 day remaining to expiration, so very tight expiration date on it. On this side of the screen, we have calls. On this side of the screen, we have puts. All right, strike prices stay the same, right? We don't need to have strikes for puts and strikes for calls, because if there's a call strike, there's a put on the opposite side of it. And then you'll notice that First Trade does a nice job of just showing you where the underlying stock is at. It's right around 189. So these option contracts are below the actual stock price, and these option contracts are above. So if I click through this, I have quite a few slides that will highlight the different scenarios here. So now if we look on this side, we have February 9th, that same expiration, but you're looking at put options. No longer looking at calls. If you buy these option contracts, you want the underlying market to go down. And then there's the strike price right in the middle. Like I said, it applies to both calls and puts. And now these are the different expiration dates. If you don't highlight it, it won't be available to you. As far as we want to be able to see all the expirations, you can do it right here, but you can also click on what expiration dates that you want to be looking at. And then we get down into the quote. So the first thing that we show here is the last. This is where the option contracts traded. So in this instance, if you look at the 190 strike call, here's the last price of it. It traded for $1.14, and it was up a penny on the day. We have then the bid price and the ask price. Now, let me grab a little bit of water. In the options trading world, these two prices are where your main focus is on. And I'm going to highlight this fact that Apple is a very popular security, obviously, and the stock has a very tight market. In other words, if you are buying Apple and you enter an order to say, I want to buy 100 shares, you would expect to pay the asking price, which is $189.82. That's where the current market is at. And if you sent a market order in, your expectation would be to fill close to that price. It's not guaranteed, but this is what the market is being displayed at. And if your order gets to the floor before that moves, this is the price you would expect to pay. Now, if you turn around and you sold this option contract, you would then get the bid, or you sold the stock, you would get the bid price, which is 1 cent below where the current ask price is at. So that's considered a very tight market. In the options trading world, there is a plethora of different expirations. We're highlighting all of them. And there are many different strike prices, which we're also highlighting. And the more and more that options that you have to buy, the bid-ask market is going to become less and less, the term is illiquid, right? Not as, you can't get in and out as easily as you can in the underlying stock. So if you look at the very popular option contracts where the underlying stock is at right now, you'll see that the market is fairly tight in these option contracts. But you get a little bit deeper in the money and it gets a little bit wider. So a lot of people don't pay a lot of attention to the last price as much as they do to the bid and ask on the option contracts. So if I'm looking at options, these are two extremely important columns that I want to look at. All right. And then also you'll notice that there's volume and there's something that's called interest, and that stands for open interest. So think of an option contract this way. If you say that there is an option contract that is available, and I'll look at this contract on the 177.50 strike call in Apple. There's only 3 contracts that have traded on this trading day, but there are 327 that are open and that are interest, and that are showing up in the open interest. And here is how this works. If you write a contract and you say, I want to offer up this contract, if nobody buys it, that option contract ceases to exist because it is a contract. So you might advertise via the quote that there is an option available, but if nobody trades it, the open interest would be 0, meaning there's no contracts that are out there. So with volume is a different beast than open interest in that the volume are the contracts that traded, but you need to know, are they buying to open the contract? Are they closing the contract? That is all happening in the volume. And then the next day you see how many contracts are opened in the open interest. So you, in general, if you're trading options, you like to have open interest. That basically, to use the term in the definition, it means that people are interested in that option contract because more and more contracts are open. That means more and more people are looking to trade that underlying option contract on that position. All right, and I'll go into a little bit more detail on that a little bit later. But if I go and I'm buying an option contract here, and let's focus on this option contract. Let's say we look at the 190 strike call and we pay $1.15 for that on a one-day basis in Apple. That means that we're paying $115 for the right to buy the underlying stock at $1.90. Now, once I buy that option contract, that would show up in the volume, and tomorrow, based off of all the other volume in the marketplace, remember there are people buying and selling, but if I bought one contract and the seller sold me one option contract, the concept would be that the open interest would go up by one contract, and you would see 40,502 option contracts. But in order to track that, we need to define some terms. So, as we mentioned when we start on the start of this presentation, once you buy an option contract, a call or a put, you are considered long. Once you sell, you are considered short. So let's say we went out and we bought that option contract. What are my choices now after I open the position? And this is much different than the stock trading world, right? First of all, I can buy to close the position. If I want to, if I bought that call option for $1.15 and the market started going up, what would happen to the price? Well, it would become worth more, right? And if the stock gets above our strike price, which was 190, well, I can go out and sell and close that option contract and just get out of that position. Now, a thing that could be bad is if the market went down and it was below 190 in our example, well, if I don't do anything, that option would expire worthless. Now, this is a bad thing if you bought that option contract, but it's a good thing if you sold it, right? So there's good and bad news with it. And then lastly, if you do nothing and we go through the expiration date and an option contract has real value, what we call intrinsic value or in the money amount, you would either buy or sell the stock. So if you do nothing, you don't close, if it doesn't expire worthless, you might exercise and buy the underlying security, in this instance that was Apple, at that strike price and own 100 shares of it, which means you got to come up with the capital to buy it, right? And that's one of the things on the call side of things, that if you are planning on buying it, you have to have the monies to be able to do that. So here's my question to you, and we'll start. And I don't see anything in the Q&A so far, but if you do have any questions, please do put them in the Q&A box. If out of these three options, 1, 2, and 3, what do you think happens the most in the options trading world? Number 1, people open and close positions before the expiration date. The options expire worthless. Or number 3, they expire in the money and they get assigned. And so we got a couple playing with our reindeer games. I think we need a few more. Number 1, number 2, or number 3. So far, so good. Justin and Patrick both coming in and saying number 1. Alex is number 1. All right, and I'll wait. Anybody else got any different opinions? No, and Paula is number 1 too. All right, and that's the right answer. Yeah, most option contracts usually get closed in the options marketplace. Now, here's one of the things that I've seen over the years. A lot of people think that the option contracts expire worthless, that is the most common thing that happens. And obviously, very astute attendees in our webinar today, because everybody got the answer right. It is buy to close. And if you think about it in just your own trading, if I buy an Apple call option, I'm usually buying the call because I don't want to buy the underlying stock. I don't want to pay all the money to actually own 100 shares of Apple at the 190 strike, or $1,900 in that instance. So $19,000 in that instance. And if I look at this and I'm doing this type of trading, why wouldn't I close the position if I'm correct on my forecast? If I'm doing this trade, why wouldn't I want to just remove my option contract and not have to deal with buying the stock? So here's the numbers, actually, and they don't change that often. The Options Clearing Corporation does actually go and publish this every year, but the number 1 instance in here that we have here is our options exercised. And this number's probably increased a little bit, and it's mainly because commissions aren't a big deal anymore, buying and selling the stock. So a lot of people don't want to try to avoid that. So 10% of all options get exercised. About 20% actually expire worthless, and about 30% are traded, opened and closed. And that's where the vernacular comes from. And this is how open interest actually gets figured out, in that if you are opening a position, you mark your ticket buy to open. And the Options Clearing Corporation makes all the brokerage firms do that. And if you close the position, you have to mark the ticket buying or selling to close, in our instance, if we're talking about a call option. And so if you look at these scenarios, as far as option trading is concerned, that number will create volume by entering that order. The Options Clearing Corporation goes in and looks at all the tickets that are open and all the tickets that are closed, and then comes in and says, this is the open interest. So it's calculated after the close how many positions are opened and how many positions are closed. Now, also remember that for every one contract that's out there in the open interest world, that represents 2 sides. There's a buyer and there's a seller of that contract. So that represents basically 2 positions that would be in somebody's account. By looking at the option contracts and looking at that open interest. So what is it? Well, I think of open interest, a lot of people, and I kind of put this little picture in here. Why is there a picture of a hot potato on this slide? It's mainly because I think a lot of people think of options as a hot potato, that there's a contract out there and somebody's got to finish with it, right? So this call option, I don't want to hear you take it. It's going to expire out of the money. I don't want you to take it. It lands in somebody's hand and then it expires worthless. And that's just simply not the case. When you look at options, they're contracts. They get open, they get closed. You can sell an option contract fairly easy, just like you can buy an option contract, which isn't the case in the stock market. But when it comes to options trading, you can. So because of that, options very, very rarely make it all the way to the expiration date. If they do, well, if they expire worthless and you sold it, that's good. If you bought it, it's bad. But you can also exercise that option contract. And that happens more on the put side of things because people buy puts to protect stocks. Markets go down, you have the right to take the stock at the lower price and put it to somebody at a higher price. So do you want to exercise and sell your stock? A lot more people would do that as opposed to exercise and buy stock, mainly because when you sell stock, you get cash. When you buy stock, you pay cash. More people like to get cash as opposed to pay cash. So that happens a little bit more on the put side of things. But here's the simple definition. Open interest is the number of option contracts that exist for a particular stock. High open interest means more interest, and that's kind of what we're showing here. Now, it can be tallied, and you hear it a lot, that open interest has increased on an underlying stock, usually meaning that there's some more activity. But it also can be reflected on each and every strike price. And some people will try to look at open interest and think that that might be a way of determining which way the stock is going. But it's important to understand that there's a buyer and a seller of each option contract. So open interest isn't really an indication of that. It just means that there's a lot of people that have traded it. Now, if you look at it, and a lot of companies will try to discern how that option came to the marketplace, right? When it came in and created that open interest, did it come in as a buy or did it come in as a sell? And it doesn't necessarily mean that the market's going to go up, but if there is a large trader that is placing a trade, some people will try to look at the open interest, try to determine, was that a new position that was added or a closing position? So people, once again, these are just kind of little misnomers, I guess, in the options trading world. I'm not saying that you can't discern if it's a buyer or a seller, but just flat out open interest by itself doesn't necessarily mean the stock is going to go to that strike price. All right, any other questions on that? And I appreciate you participating in my reindeer games. I appreciate that. All right. So what I want to do now is I want to run on over to the options play platform, and we'll look at a few positions if you would like to. And I want to highlight a few of these things that are available to you. Now, inside the first trade, you have you have different availability as far as the software is concerned. But I do want to highlight something that is new in the platform. As a matter of fact, it just came out this week, and it's inside the watch list. So this is the options play platform that you have. Everybody has access to at First Trade. And if you look at the watch lists, we now have watch lists that are available that will have personal watch lists. Okay, global. Here we go. That have overvalued and undervalued stocks. So undervalued stocks are going to be more of a buy indicator in this instance. And oh wow, we got a big move up in Apple today. That's a good sign, just in general. And if we look at overvalued stocks, well, that might be a sign that they could be sold. Undervalued stocks, let's go down and look at this. undervalued stocks. There we go. Are more option contracts that you might want to buy. Adobe is showing as an undervalued stock in this instance. If I want to trade that and I am bullish, everything's going to lean bearish, mainly because the market is just so bearish overall. But in this instance on Adobe, we are actually showing a bullish counter trend for Adobe. And we're kind of highlighting that maybe this thing is oversold at this point in time. So if I'm bullish on that underlying, I can buy 100 shares of stock, I can buy a call option, I can look at a vertical spread. So I'm going to highlight this because this is a basic seminar. We're going to just look at buying a call option in this instance. And if I did want to trade that option contract, we're going to highlight that we're going to go out 72 days, give this option contract a little bit of time to run. We're going to look at the strike price relative to the stock. So we're actually getting some real value inside our option contract. The premium going out that far in time is $34, mainly because of where volatility is at and the expensive underlying. Well, let's look at something that's a little less expensive. Let's try to find, Bank of America is a good one. So let me click on that. And that will be a lot cheaper option contract. So this also gets back into the pricing. If I'm trading an option and it's an expensive underlying like Adobe, which is a $339 stock, those option contracts are going to be more expensive just because of the price of the underlying. If you think of options as where they came from as an insurance product, right? Is it going to be more expensive for you to insure a Bentley or a Chevy Cavalier, right? The more expensive the underlying, the more expensive the insurance product is going to be on that. And call options and put options come from that same world. So if the price of the underlying stock is more expensive, the option contracts are going to be more expensive. Just like buying 100 shares of stock. It's going to cost you more to buy 100 shares of Adobe than it is to buy Bank of America. So in this instance, if I'm looking at Bank of America and I got a bullish idea, we got another bullish counter trend that is showing here. And we want to buy a call option. If we look at this option contract going out 72 days, $3.35. So that's a fairly inexpensive option contract, and it's highlighting to buy something a little bit in the money. So $33.57. So in this instance, we're paying $3.50 or $350 for the right to control 100 shares of Bank of America at $33 a share. Our max risk is $350, and our max upside is going to be unlimited because we actually own that underlying stock. So let's go and look at the profit and loss graph here. If we pull up this underlying stock, it shows you that we have substantial upside if we buy this outright, and we have limited and known downside. So if you're thinking about this marketplace and you wanted to own some Bank of America, but you're a little skittish about the market, here's the way a call option would work in that scenario. I'm not going to go out and use the option contract to buy as many options as I possibly can based off of the monies that are in my account. I'm thinking I was going to buy 100 shares of Bank of America. If I buy 100 shares of Bank of America, is it possible to lose $3.50 or $355 on my 100 shares? And the answer is yeah, it's very feasible that if I buy that, if the market could go down, today it's down $1.46, but over the next 72 days, could it go down more than $3.55? And if it does, well, then you're going to lose more than $3.55. How about I say the markets are a little rough, I want to take a position in Bank of America. Let's buy one call option that goes out 72 days and gives me the right to buy the stock fairly close to where the stock is at right now. And if the market goes up, my call option will go out and I can either sell it or I can exercise and I can buy that stock at that strike price. So this is one way to look at the options marketplace, especially in a market like this. and try to use options as a way to limit your risk on the downside. Now, if you go and you say to yourself, well, Bank of America is trading for $33. If I buy 100 shares of it, that's $3,300 divided by $350, which is the price of the contract. So 3,300 divided by 350, I could buy 9 contracts. So I'm going to use the leverage factor. I'm going to come out and I'm going to buy 9 option contracts as opposed to buying 100 shares of stock. Now I'm using options to leverage my portfolio. I'm going to buy it because I definitely think it's going to go up. I'm going to take all the capital that I was going to use to buy the stock, and I'm going to buy 9 of these option contracts. Well, if that is the case, then you're using options to speculate. So if you're a beginning option trader and this is Bank of America is down, and let's say you had 100 shares of Bank of America and you were thinking about buying another 100 shares to double up to catch up. Maybe this will give you that opportunity to spend a little bit of money, have the right to control that 100 shares, but not have all the risk as far as that position is concerned. Alex says, what about the IV being high? Is it too high for option trading? That is a relative term, and if it's high on option trading, there is additional risk that's involved. Now, if you want to go to the next level and you're worried about that, well, we also give you that availability, and we want to look at something that's called a vertical spread. Okay, so if I click on this option contract, right, and we look at this trade, we're spending close to the same amount of money. It's $2.97, but I am buying one option contract and selling an option contract. So if volatility, as you mentioned, Alex, is hurting the option contract that I buy, it's going to be helping the option contract that I sell. So in this instance, you're bringing in 52 cents, paying $3.35. I would actually kind of modify this. And I don't think, and the stocks could go up to 41. Let's take this, let's modify this a little bit and try to bring in a little bit more premium on the options. So if we look at the 39 strike, which is 6 points higher, which is still a very solid move in the options trading world, I can bring in a premium on that call option of 92 cents, and the midpoint right now is $2.57 to trade that option contract. So $257. So this is one of the beauty of what First Trade offers, and on top of the fact inside the options play software, there are chains that are available to you that will help you decide on these. And inside the platform, if you are looking at the platform, you actually have the ability to look at, here's the scenario if you buy the stock outright. Here's the scenario if you just buy a call option. If you're worried about implied volatility, as Alex saw here, the IV rank is very high, and that's saying that volatility is very high, which just in the whole marketplace is high. Then here's a different alternative where we can do what's called a call vertical spread. Now, if you're going to do that inside the First Trade platform, you have to have the ability to do spread trading. So you have to fill out an account application, apply for option trading, and make sure that you are approved in order to do these types of trades overall. Any other questions on that? Or anything that you want to look at in general in the options trading world? Very nice to see that Apple has made a little bit of an upturn. I think that's just good overall for the markets. But the markets are still a little rough. Right now, if we click on this, let's see where the SPY is at. Yeah, we're up a little bit. Not bad. Not bad. Good sign. Okay, so Alex says, I own bank. Do I buy a bearish vertical to protect my bank position? All right, I like that question. Alex, so Alex, you're using options as protection for your portfolio. So if I do a protective put, and I'm going to run over to my book, okay, the options playbook, and we look at a protective put. And this is where I thought we might get to in this presentation today. A protective put means that you own the stock, and I'll scroll up to the top here. You own the stock and you buy a put with strike A. So you own the stock, you buy a put at strike A, you have limited and known downside, and you have unlimited upside because you still own that underlying stock. And this would be called a protective put. Looks very similar to a call option, doesn't it, Alex, like we just talked about? If we look at the option strategy a long call, you'll notice that the profit and loss graph is very similar. You buy a call option, you have limited and known downside to the premium that we paid. In Bank of America, it was $3.50. You have unlimited upside all the way up until that expiration date because you have the right to buy the stock at the strike price. And if you own long stock, you have unlimited upside. All right, so there were two different ways that we approached it. We talked about buying the Bank of America call option as opposed to buying the stock outright. If you own the stock, you can buy a put. And buying that put will limit your downside, but allow you to continue to own the stock. So Alex came up and said, is there a way that I can do this without paying that premium for the put? In other words, I showed you how to reduce the price of your call option. What about if we go in and we do you said a bearish vertical, which would mean you're doing a long put spread. All right, so in this instance, you buy strike B and you sell strike A. So I don't pay all the premium I don't pay all that volatility premium on strike B because I also sell one on strike A, but I'm limited in my insurance product. I don't have from $33 in Bank of America all the way down to zero. I say I only want to be insured for the first 5 or 6 points. I'm not worried that it's going all the way to zero in this instance. And so that is a decent alternative. If you want to use options as protection and you want to get through this rough period of the marketplace, buying a long put spread is an alternative to just buying a put outright. So let's go in and look at Bank of America. And we're highlighting, see, it's saying it's bearish, so it's highlighting that we're in a bearish trade position. And here is a put vertical going out to June. Let's look at these strike prices. All right, it's saying that we're going to buy the 34 strike put, which would be the zero insurance, zero deductible basically, because that's where the underlying stock is at. And that's $3.25. Very close to what we would be paying for the call. And there's rationale behind why that is. It makes sense. And then you sell the 25 strike put. So instead of paying $3.25, you pay $2.44, which is quite a bit of difference. You're talking about $244 versus $325. And then I'd also approach it as, this is my insurance product. Do you usually buy the zero deductible insurance product when you're looking at your car insurance? No, usually most people will have some type of deductible. So to take that concept and look at it as a protective strategy here, let's go in and let's modify this. And we got the 34 strike put. Are we willing to take some risk? Will we say we're okay, we don't need our insurance to kick in until it gets below 33? Well, if we go to the 33 strike, now we've just saved quite a bit of money, right? $2.79 versus $3.25. And then if you're willing to take another point of risk, you could go $2.40 in this instance. So 32, it's going to give you 7 points of protection from 32 down to 25. And if I hit the midpoint, I'm going to just put the mid in, which will, you can't always trade at the midpoint. I'll talk, I guess, a little bit about that on execution. But that is the price right in the middle. So if you hit the bid, it would be 178. If you could finish somewhere in the middle is 161, and your ask is 163. So now I have protections of 7 points from $32 down to 25. I'm going to pay $1.60. And the underlying stock is at 33.67. So you're looking at 4% of the underlying stock price to protect you for the next 7 points of downside. And then you have unlimited upside because you own the underlying stock. So is it worth it? So you have to decide, I've lowered the cost down to 160. I only have protection from 32 to 25, but this is a much cheaper way to do it than buying this option contract outright. Yeah, so I guess, Alex, in general, if you're worried, I'd actually adjust the days to expiration too. I don't know if we need to go out 72 days. If I'm literally buying this as an insurance product, you could actually lower the cost by clicking this, and let's say we go out 30 days. And here's my attitude when it comes to protection. And now let's look at that trade. 128. So we've lowered it down to $1.28 in total cost. So we go 30 days, $1.28 divided by 33.6. So now we're down to under 4% on the total cost of that trade. And if you do this, you got to say to yourself, do you think the marketplace over the next 30 days can offset this? Which is really nice compared to your car insurance, right? You're not going to drive your car around and at the end of the term, your car's worth more than what you paid for insurance, right? In the options trading world, though, and stock world, that could be possible. So if you think the market can go up 128, that's your best case scenario. And I also want to highlight this too, that if you do protection, you want the market to go up. Your best case scenario is if Bank of America, goes back to the 40 level. We see here on the chart, 40 is about where the downturn started, right? 41, somewhere between 40 and 42. That would be your best case scenario, and that this would expire worthless. So it's really hard in option trading to always say, people say, 80% of option traders lose money. Well, if that happens in this scenario, I didn't lose money. I protected my Bank of America position, but my options went out worthless. So it's just always hard to judge that because you need to look at the entire portfolio to try to decide what was positive, what the move was for the marketplace. All right, a few more questions. What would you do for UPST? Okay. Oh, that upstart, that's it's up today. Yeah, you could do the same scenario. We still got an extremely high implied volatility, which is going to be the case with everything. It's somewhat liquid, so liquidity isn't as high in upstart as it would be in Bank of America. It's showing bearish. You have the vertical, so we're going to come here. If we click trade, you're going out to 72 days, so it's defaulting to that because it's not looking at it as a protection trade, right? It's looking at it as what we're looking to do if we were to just be bearish on the underlying. So I'd modify this. Let's grab it. Modify. I always think, and here's one of the things about insurance too, and you might even, I don't even mind going 16 days in this instance to lower it, and we'll hit the midpoint on it, mainly because I don't believe that if let's just say in general, you're buying stocks. If you are truly bearish on the stock, you don't buy a put with the right to sell at a certain price, right? Because you're paying for that. And insurance on stocks is a lot more expensive than insurance on your car or on your house relative to the valuation. So if you really think that you should just buy puts over and over again to protect the stock, you might just want to sell the stock, right? You're going to do this to get yourself through a tough period. Now, the underlying stock is paying in May 6th. So we're not that far away. So that is a date that could be a catalyst to the upside, but also a catalyst to the downside on May 6th in this scenario. So in here, we're looking at this put vertical. 30 days is fine to me. And if you're really just nervous about the news headlines right now, you can even go out 16 days. This is one of the things that's wonderful about the here and now options place is you have all of these different expirations that you can choose from. So I'll keep it on 30 days. Market is at 36. It's up a little bit today. Where would you want to be at? 35 maybe? So you got 1 point before your insurance kicks in. And then let's go down. Wow, on the downside, you're getting a lot of premium down below. So that's just because it's such a volatile underlying stock. I guess we'll do the 25s. All right. 390. That's a little bit expensive, but that gives you 10 points of downside. So in your instance, you can shorten that, right? So you get 10 points of downside, which is a ton on a $36 stock. Yeah, we probably need to adjust that, don't we? So if we're gonna look at it now, nothing's meant to be a recommendation, but I'm highlighting my process that I would go through. So if we do the 30 and we give ourselves 5 points, that's 6 points would be 20% approximately, right? 5 points is a lot. So in this instance, now we can lower the cost down to $2.13, and it makes it feasible. So if you want to protect yourself for the next 30 days, you can put this position on, buy the 35 strike, can have protection from 35 down to 30, pay $2.13 for that, and then sleep a little bit better at night on Upstart, if you will. Now, the downturn in Upstart, though, just in general, I mean, the stock's been cut in half, right? It was $90 all the way down to 40. But how long did that? Yeah, that was in a couple of months' time. So Upstart is just, in general, a scary underlying, and it was without all of the tariff wars going on. But right now, at this point in time, this would give you something to give you a little bit of protection. What would be the best expiration date to be less risky? Well, I just always err to the side on protection. On protection, I err to the side of going short term, because here's the other thing too, is if you buy this and you put this on, and the market goes up in 15 days, and before you know it, it's trading at 45. Let's say we get back to this level right in here, that would be 50. We're trading at 50. Well, then your insurance is worthless basically, right? It's not really providing any protection because you're all the way up to the 50 level. So that's where, if you're doing shorter term, you have the ability to adjust it, and you can say, well, it's at 50 now, I want to do another protection put spread if I would like. So did you kind of understand? This is part of the reason why I like to use protection and do it on a shorter term basis, 2 weeks to maybe 30 days. I don't want to go out more than 30 days when I'm doing protection at all. All right. And that was Paul. What would be the best expiration day to be less risky? Well, it's not about risky, right? Because you're protecting yourself. The expiration date in a protection is much different than the expiration date if you just want to get bearish. It's a totally different outlook. And mainly because of what I said. If I do put this on, and all of a sudden I turn around and the stock does get back to 45, which is very feasible by looking at this chart, that it came down that fast, maybe it goes back up that fast, right? Then your protection just isn't helping you as much, and you paid for 30 days when you could have paid for 15. Does that answer anybody's question? I think so. All right, so Paul asks, when buying a call. All right, so the same thing, if I'm buying that call option, in this day and age, I'm going to stay on a shorter term. And Tony Zhang, the chief option strategist, has recently done talking about zero DTE options inside. Actually, I think that position was done in the education that we did for First Trade, and those are options that are really interesting because of the volatility of the marketplace, and you get rewarded really quickly. Now, they're not investing, they're speculation in this instance. If I'm going longer term, I really want to just get bullish on Bank of America in our instance that we talked about. I'm probably going 45 to 60 days out, somewhere in that range. That's a decent rate of time decay, and you are still going to be paying up for implied volatility, which somebody else mentioned. So if I'm just buying a call option outright, I like that time frame to err on the side of being a little bit longer dated, even though I may get out in the short term. If I do it for 60 days, it doesn't mean I have to hold it for 60 days, right? We talked about most people sell their option contract. So if I buy it and it goes up, I will close it and get out. If I paid $3.50 for that call option we were looking at, I would then sell it for $7, maybe. Let's say we doubled that, get out of the position. I wouldn't wait all the way to that expiration date. And also, Paul, this is going to highlight that a little bit more. So let's go back to Bank of America, and the platform and also the option contracts that are offered inside of First Trade are going to be more optimal in that scenario. In this call option, looking at Bank of America buying this, it's gonna go out 74 days, 72 days. All right, I said 60. I think that's a little bit long. I would look at going 60, but it's going to give you, the platform is going to give you, and the chains are going to give you what they consider the most optimal expiration date on that. So I'd stick with the platform, I guess. I guess that's the moral to the story. If you have a question. All right, a lot of thank you. I'm new to options trading. What you recommend I start studying? Well, I have a little book called The Options Playbook. All the information is available for free inside that. First Trade has a lot of great education, a lot of seminars, a lot of basic option trading strategies. You don't have to buy the book, actually. Where I would recommend starting, Deshauna, is just right here in the Rookies Corner. And it's all for free, or you can buy the book if you want to pay some dollars. It all comes back to me. But within this instance, everything that I publish in the book is actually covered in this section. All right. Answer. Yeah, it looks like we got them all. Okay, everybody. I got one last one. Paul or Dan, who is out here? Are you still here, Alex? Alex, are you here? All right, Alex, here's one thing that if you want to do a trade where it's a covered call, you can get a lot of premium in these option contracts. And I kind of like to highlight that you can do that. So if you're looking at a covered call position right now, there's an alternative to a covered call, and trying to think where I could reference this. I don't know if I did it inside the First Trade platform, but look at this strategy here, okay? And I like to call it a double up to catch up. So front spread with calls. All right, so if you look at this trade, this is an alternative to a covered call. And you want the marketplace to come back, but this is a front spread with calls. It has unlimited risk unless you own the stock. If you own the stock, you can turn this up and it will look like a covered call option. All right, in that you buy a call and you sell 2 calls and you bring in a net credit to the account. I like this as, I don't want the cheese anymore, let me out of the trap. So for example, if you own NVIDIA, if you own Apple and the market has bounced back, let's see where NVIDIA is today. I'm just naming stocks where that a lot of people own. I'm not doing it in any particular. So yeah, it's bounced back $5 or so. So in this instance, let's look at, I'll call it a covered call on steroids, just for lack of a better name, right? Let's look at a vertical spread. We'll trade this and we'll modify it. 100 to 120, $12, $9, okay, 72 days, all right? Let me take that and modify it. Okay, you own 100 shares of stock. Don't forget that, because this trade is unlimited risk unless you own 100 shares of stock. If you are looking for, NVIDIA took its downturn about 140, and it started with the DeepSeek news. And if you're looking to try to just get a little bit of that back, as opposed to just selling a call outright, let's do 105. Let's do a different expiration. Let's start in here. Heck, we can go probably 23 days would probably be all right. Buy the 105, which is really expensive. Once again, the IV rank is really high. I'm saying implied volatility is really high. And I think we could probably get 7 points. Let's go. Now we'll do the 110. $0.75 net credit. Let's do 110. Let's go down. So 5 points. All right. All right. So here's what I'm doing here. This is an interesting trade. If you own 100 shares of stock. If you own 100 shares of stock. If you don't, you have unlimited downside because you are long one and you are selling two. Okay? You're long one and you sell two. So you have your net short an option contract. But if you have $100, you grab this graph that's looking like this and you make it look like a covered call. And from 105 to 110, it's like you own 200 shares of NVIDIA. So here's the trade. You bring in $1.45 net credit to the account, just like with a covered call. If you sold the call, you would get $3.50, saying you could call the stock away from me at 110, which is scary with NVIDIA because, you could get pegged in that scenario and be prepared to take your stock away. But in this scenario, from 105 to 110, you have an extra call option that you didn't pay for, right? Because we sold two of these, but from 105 to 110, you are long a spread. So you're saying if it goes to 110, I can make $5 on this spread, and I make the money because I own the underlying stock, and I bring in a net credit of $1.45 or $145. If the market goes down, I get to keep that, but down is scary in this marketplace. It's a small pillow to land on as the market falls. Not a big mattress, it's a small pillow, right? As opposed to, I would say, the bear put spread is a big mattress, right? It's a thick mattress. It gives you a little bit of leeway. The call situation does not. But it gives you an opportunity, and this only really works well when implied volatility is high. That simple. You need to get a lot for this call option, which $3.50 for 23 days worth of premium is pretty good. All right. All right, everyone. Well, I think that is it. Thanks for hanging around. I do appreciate it. And it doesn't have to be in NVIDIA. It can be in look at Google, look at anything that has a lot of volatility recently and that have been beaten up. Whatever, Apple is a great scenario, but Apple's looking really good today, 181 at this point in time. So it's making a strong comeback. Thanks for stopping in. My name is Brian Overby, and I'll go back to my PowerPoint here. My book is called The Options Playbook. The website is optionsplaybook.com. And I want to thank First Trade for allowing us to come in and provide this education for you. And if you have any questions or concerns, you can follow me on X. My handle on x.com is @BrianOverby. Thanks for stopping in, and we'll see you next time. And until then, may all the options you buy finish in the money, and all the ones you sow finish out. Thanks, everyone.